Good afternoon, folks. This is your host Mandeep. Today is Sunday, July the 12th, and today we'll do a recap between me and Aman. Aman has been doing a daily recap, just highlighting some of the trades that we take, and I hope that's helping some of the subscribers in understanding what our thought process is. So, Aman, tell us a little bit about some of the trades that you took on Friday. What was your focus, and what was your selection criteria?
Okay, Mandeep. So the first thing that I like to look at every morning is the sector performance list. So this is a list that we have right here, and you can see that I've ranked this by percent change, and these internet stocks were doing the best on Friday. So that's initially where my focus shifted. So with that in mind, the first trade that I looked at was Netflix. As you can see, Netflix had the highest relative volume throughout the day. Coupled with a signal that we also got and an orb break. So these are 3 points of data that I like to look at, but I like to have as many points of data as I can throughout the day when it comes to trading. So if we take a look at Mandeep's Discord room, you can see that in the morning that he had posted this list, his focus list of Tesla, Netflix, Roku, and Amazon. Along with that, we also looked at a bit of crowdsourcing, what other people were talking about during the day, and you can see that Netflix, Tesla, Amazon, and Roku were all on that list.
Yeah, interestingly, what we see is that the relative volume was already high, even in the initial 1 hour, right? So we can see it highlighted in green, and that shows us that there was a certain amount of institutional interest on these stocks, and those are the kind of things that you want to look for anyway.
Right, so with all these, that's about 6 different points of data that I have when it comes to taking this trade. And you can see when the signal came about around 5:25, it went just crazy for the rest of the day, and here was the close. So this is what I like to call a really, really good trade. Really happy with this one.
Yeah, and I think there was some good option flow on this as well, right? And they were buying options expiring for Friday itself, right? For what is the current price? It's trading at 548. They were buying 525s, right? And they had put some significant amount of dollars into that trade as well. So I think all of that combined made perfect sense to be in this trade.
Exactly. So the other trade I took was Tesla, and I know this isn't an internet play, but it again had very high relative volume, and again you can see that this was one of the focus stocks, another one that was crowdsourced as well. And along with option data, I had actually noticed on Thursday that there was people were buying 1,500 calls expiring for that Friday, and you can see this stock was only around 1,400 when this trade was executed, and I mean it just took off like crazy. Closed at 1,544. So whoever had taken that trade, they definitely knew something, and they were definitely right about that one.
But you obviously have no idea early on in the morning that this is actually going to trade 100 points. Actually, nobody knows. Right?
Nobody knows.
So it's just that when the signal comes, you're always taking the trade.
Yeah. So when you have these very high volume days, and a lot of people are obviously talking about the stocks, those are just ones that you have to take, and you just have to be in the trade.
The most important thing you focus is, of course, the signal, right? You have to have the signal before you would take the trade.
Yeah,
and the other thing I noticed was that there was also a significant amount of option trading that they were doing on Friday as well. Right?
Yes.
So they were buying, calls that were fairly, out of the money, which showed that there was definitely a lot of institutional interest in the stock.
Exactly. So I just wanted to show you guys a few of the trades that we had taken today. So as you can see here, we took some spreads on Tesla as well as Amazon, and also some shares on Tesla, Roku, and Netflix. These were, again, the ones that we had just pointed out that were being talked about, and these were our focus stocks for the day. And with all those combined, it was a $2,000 trading day. So that's where we like to have our focus, and and those are the trades that we like to take. So Mandeep, with that all in mind, can you just give me a little bit of information on kind of like your market outlook, sort of like the dynamics of the market, what type of indicators you might be looking at to help give me a sense on, should I be heavily invested in the market at this point, or should I kind of, be a little bit more cautious in my approach?
So thanks for the recap, Aman. So over the weekend, I started to look at some of the statistical aspects of the market, which is something I normally don't look into. So the main focus for me has been on the Qs, right? The reason is because the Qs seem to be the most overextended. I think the Russell as well as the SPY seem to be in a more reasonable range. But clearly because of the 4 or 5 stocks, the Fangman stocks that are causing the Nasdaq 100 to make an explosive move over the last several weeks, and that's exactly what I wanted to look at. So one of the things I looked at was I looked at the standard deviation channel, right, and see how many sigmas or standard deviations are we out currently. So under normal circumstances, I suppose if you know that the market is kind of like an elastic band, right? It trades a certain amount around its a mean position, as an example. And so under normal days, we'll have a 1 sigma move would imply that the market is trading 68.27%. There's a 68.2% chance that the market will trade in that range. Now, if you have a 2 standard deviation move, then the market is going to trade, in that range 95.45% of the time. And if you have a 3 sigma move, then the market is going to, remain in that range 99.73% of the time. So at this stage, we're definitely way out of that range, right? And at the bottom, what I've done is I took a look at the 200-day closing, simple moving average, and I started to compare with how far was it stretched, right, during the dot-com era. So if you look at what happened during the dot-com era back in 2000. So the market was approximately trading, or the Qs were trading approximately 59% above the simple moving average of 200 days. So that was actually pretty significant, right? And after that, we had that big drop in the market, and market got really cut in half or more. And what I've noticed recently is that we're actually basically reaching that same level of exuberance right now, right? So if you notice, I've plotted a line around 42%. So last time when we hit about 42%, we actually had a pullback in the market, which happened here. And then right again here, you notice that we were a little bit above 46% stretch between the close as well as the 200 period moving average, and the market had a significant correction, right? And now we've actually taken this level out as well, and for the last couple of days we've been trading very close to about 54%, and the dot-com era was 58. So we're very, very close to that. And also some of the sentiment indicators that I'm looking at shows that the market has the same level of exuberance as the dot-com era. So now, one thing I wanted to point out is just because this is actually, it's getting close doesn't mean the market is going to come down immediately. If you look at the dot-com era as well, we remained in that range for several weeks. In fact, even longer than that. So this doesn't mean that you can start to short the market, but what you need to do at this point in time is be a little bit more on the cautious side, right? Because currently, if you look at the market, and I'll show you the sigma move that we currently have, and you can currently see the market is trading over 4 sigmas out of the from the 200 period moving average. What really that means is that this kind of an event where you have a 4 sigma move theoretically occurs once every 43 years or twice in your lifetime, right? So clearly we are in uncharted territory right now. So in other words, the probability of something like this is really extremely small. It's like 0.00 2% or something, right? In other words, let's for a moment assume that you're trading options, and if you figure out that the delta of an option is so minuscule, right, that is going to happen once in every 43 years, it's very unlikely that you will take that trade. So if you take that same analogy, then the market today is so overstretched that the risk reward ratio is really not in your favor. Right. So what that really means is that you do not want to initiate like new positions that are swing positions, but we can clearly day trade. There'll be a lot of like day trading opportunities, and we cannot make an assumption that the market is just going to drop tomorrow or day after, right? So we have to play this by the ear. We have to play it by the charts, and the signals are going to tell us the precise point when the market is going to, when it turns, we will be able to see it. Right. So hopefully this gives you a little bit of an insight into what my thought process is. But at the same time, I also think that the S&P 500 is not overstretched. Right. Okay. So that's pretty much it for this weekend, and we'll see you again next week.